On August 12, 2024, Fisker Group Inc. filed for bankruptcy, shaking the electric vehicle world. This filing raises a crucial question: will other EV companies soon follow suit? As Fisker, with its bold electric designs, battles financial difficulties, the entire industry is on edge. With major players like Tesla, Ford, and GM also grappling with their own challenges, the future of the EV market is uncertain. In this video, we're going to delve into Fisker's downfall and uncover what this means for the broader EV landscape. Fisker Group Inc., a name that once buzzed with promise, has just filed for Chapter 11 bankruptcy protection. This move marks the second electric startup to hit the financial rocks this year. According to their filing with the U.S. Bankruptcy Court in Delaware, Fisker's assets are estimated to be between $500 million and $100 billion, while their liabilities range from $100 million to $500 million. And let's not forget, they're tangled up with 200 to 999 creditors. So, what went wrong? Fisker, known for its 2022 Ocean SUV and the luxurious Karma plug-in hybrid, has had a rough ride. Founded by Henrik Fisker, a designer with a flair for high-end vehicles, the company aimed to rival industry giants like Tesla. But despite their flashy models and ambitious goals, they've stumbled. They've cited numerous market and economic hurdles that have tripped up their operational efficiency. After exploring all possible avenues, Fisker decided that a Chapter 11 sale of its assets was the best way forward. Henrik Fisker wasn't a stranger to failure. His previous venture, Fisker Automotive Inc., also went bust back in 2013 after snagging a hefty $529 million loan from the U.S. Department of Energy. That's right, Fisker's journey has been a bit of a roller coaster. Fisker's bankruptcy is just one piece of a larger, troubling puzzle in the EV market. The electric vehicle sector, which was once riding high on a wave of excitement, is now facing some serious turbulence. Even the big players are feeling the squeeze. Take Tesla, for example. Once the shining star of the EV world, Tesla is now grappling with a major challenge. In the 12 months leading up to May, Tesla sold around 618,000 electric cars in the US. Sounds impressive, right? But it's only a tad ahead of the 597,000 EVs sold by other manufacturers combined. This close competition is a clear sign that the market dynamics are shifting. Tesla's sales dropped by a notable 13% year over year in the first quarter, causing some serious concern among investors. Meanwhile, competitors like Hyundai, Kia, and Ford are making waves with impressive growth rates ranging from 56% to 86%. Traditional automakers are quickly catching up with their new and improved EV models, putting Tesla's once dominant position at risk. For one, Tesla's focus on just two models, making up 95% of its sales, has left it vulnerable. While Tesla sticks to its guns, competitors are offering a wider variety of EV options. Plus, CEO Elon Musk's often controversial public persona and polarizing views might be affecting Tesla's brand image and sales. Despite these challenges, Tesla remains the largest EV maker in the US, with its Model Y still leading global sales. But as competition intensifies and Tesla's market share potentially shrinks, the company's financial outlook could face more pressure. Now, let's talk about Ford, another heavyweight in the automotive world. Ford is also wrestling with significant financial losses in its EV division. In the first quarter, Ford's electric vehicle unit, Model E, reported a staggering loss of $1.3 billion, about $132,000 per vehicle sold during that period. The company's revenue from this unit plummeted by 84% to around $100 million, primarily due to industry-wide price cuts and rising costs associated with new EV technology. Ford has invested heavily in research and development for electrification, but those investments haven't yet paid off. The company is projecting a $5 billion EBIT loss for Model E for the full year. Despite efforts to cut costs such as slashing the price of the Mustang Mach-E by around $5,000, Ford is struggling to keep up with falling revenue. On the flip side, Ford's traditional vehicle sales through its Ford Pro unit are performing well, contributing positively to overall profits. However, the losses in the EV sector are substantial. Ford Pro, which focuses on fleet sales, is experiencing robust growth, while Ford Blue, handling consumer sales of gasoline-powered vehicles, has seen a revenue decline. And then there's General Motors, GM, which is also navigating the choppy waters of the EV market. GM has managed to reduce its EV losses compared to previous years, but the challenges are still significant. The company reported a narrower EV loss of $2.5 billion in 2023, down from $3.3 billion in 2022. Despite this, GM has seen $43 billion in revenue and $2.1 billion in net income attributable to shareholders as of January 2024. However, GM has lowered its EV sales goal from 400,000 to 250,000, reflecting the difficulties in scaling up electric vehicle production. One hiccup for GM was a production halt of the Chevrolet Blazer due to software issues, news, which affected its eligibility for consumer tax credits. But GM is planning to reintroduce the Blazer and Cadillac Lyriq with eligibility for these credits to boost sales. GM is also reintroducing plug-in hybrid electric vehicles, PHEVs, as a bridge to full electrification. This pragmatic approach aims to address current consumer demand and infrastructure readiness. Despite these efforts, consumer confidence in EVs remains uncertain, with a Pew Research Center report showing a 4% decline in interest in EVs from May 2022 to July 2023. The struggles of major automakers underscore a broader trend of shifting market dynamics and growing consumer skepticism about electric vehicles. As companies wrestle with profitability and increasing competition, several key factors are shaping consumer trust and the broader adoption of EVs. One major issue is the high repair costs associated with EVs. Unlike traditional vehicles, EVs often require specialized repair services that can be more expensive due to the need for specific tools and expertise. This can significantly impact the long-term affordability of owning an EV, making potential buyers wary of their investment. Another crucial factor is the availability and efficiency of charging infrastructure. While urban areas are increasingly well equipped with charging stations, rural regions often lack adequate facilities. This disparity can lead to range anxiety, where potential buyers worry about finding charging options and may be deterred from purchasing an EV. Price wars among EV manufacturers are also contributing to the industry's financial instability. The competition has driven down prices, which, while attractive to consumers, has squeezed the revenue and profitability of many companies. As manufacturers cut prices to attract customers, they face increased pressure to manage costs and maintain financial stability. Government policies and incentives will play a crucial role in shaping the EV landscape. Supportive regulations and subsidies are expected to drive demand and influence market dynamics. However, the industry's ability to overcome its current financial pressures will be a key determinant of its long-term success. Despite all the challenges, the global electric vehicle EV market is set for a major transformation. In 2023, the market was valued at an impressive USD 388.1 billion. Projections suggest it will nearly triple, reaching USD 951.9 billion by 2030, with a compound annual growth rate aka CAGR of 13.7% from 2023 to 2030. This rapid growth is driven by several key factors. Technological advancements are a significant driver. Innovations in battery technology and electric powertrains are making EVs more efficient, affordable, and appealing. Improvements in battery life, charging speed, and vehicle performance are enhancing the consumer experience and spurring wider adoption. Environmental awareness is another crucial factor. With growing concerns about climate change and air pollution, electric vehicles are increasingly seen as a solution for a greener future. Their zero-tailpipe emissions align with a global push for reduced carbon footprints driving demand. The EV market is diverse, with different segments showing varied growth patterns. The commercial vehicle segment, including light and heavy commercial vehicles, is expected to grow rapidly. Companies like Volvo Group, Daimler AG, and BYD are leading this segment, with ongoing developments in electric commercial vehicles. Additionally, mid-priced EVs priced between USD 30,000 and USD 45,000 are projected to dominate. Models like the Hyundai Ioniq 5, Ford Mustang Mach-E, and Tesla Model 3 are popular in this range, balancing affordability and features. Regionally, Asia-Pacific is set to be the largest and fastest growing market. China, a global leader in e-mobility, achieved over 20% EV sales by 2023 and is expected to reach around 35% by 2024. India plans for 30% of its passenger car sales to be electric by 2030, while South Korea and Japan aim to become top EV producers. Looking ahead, several dynamics will shape the EV market. Increased competition and innovation in battery technology, autonomous driving, and vehicle design will be critical. Expansion of charging infrastructure and regulatory changes will also play significant roles. As EVs become more mainstream, evolving consumer preferences will influence purchasing decisions, while economic conditions and environmental factors will impact market dynamics. What do you think the future holds for electric vehicles? Will the industry overcome these challenges, or are we witnessing the beginning of a major shift in the automotive landscape? Share your thoughts in the comments below, and don't forget to hit that like button and subscribe to stay updated. Thanks for tuning in.